Hi, everyone. Thanks so much for checking out my show, Coin Stories, where I get to hear from the leading voices in Bitcoin, financial markets and investing, political structures, philosophy, and more. Please make sure you're subscribed to the show. And if you're watching this on YouTube, like the video so more people see it, and hit that notifications button so you don't miss out on any new content. This podcast does not provide financial advice. It is for educational and entertainment purposes only. So make sure to do your own research before making any investment decision and be aware of your risk tolerance. I'm able to produce this show thanks to my sponsors, and I'm very picky about who I choose to partner with. So I hope you take the time to listen to the ad reads throughout the show. All right, now to my first partner, where I buy my Bitcoin, Swan. I'm proud to partner with Swan because it is a Bitcoin-only company focused on helping people save for their future and self-custody their Bitcoin, not trade it. Swan offers a private client service, retirement planning, tax loss harvesting, and even home equity conversion. Swan is also committed to educating millions of future Bitcoiners through free educational resources and media projects. I actually use Swan to dollar cost average every day. I deposit a little bit every day that's equivalent to what I might spend on a meal, because I actually read that dollar cost averaging daily ends up with a lower cost basis than weekly or bi-monthly at the end of a given year. Swan also produces my show, Hard Money, which reports on Bitcoin adoption and macro trends around the world. So make sure to subscribe to that as well. And to learn more and get $10 in free Bitcoin when you sign up, head to swanbitcoin.com/Natalie Brunell. All right, it's time for the show. I'm so grateful to be joined again this week with Danielle DiMartino Booth, who's CEO of Quill Intelligence and author of Fed Up. Thank you so much, Danielle, for joining me. This has been a tumultuous time. I know you've gotten some feedback before and after you wrote this excellent article called Too Small to Fail. And we're going to be talking about that as well as some of your takes on what's happening with the banking crisis. But thank you so much for joining me.
Natalie, it's great to be here. I just, there was a tiny bit of a typo in that. It was too small to not fail.
To not fail.
And that's kind of the whole point of where we are today with what I believe to be, even if it's a calm down banking crisis, I don't think it's over yet.
Well, let's get into it. And first, since you have, so much experience and you worked for the Federal Reserve, I want to sort of back up and zoom out, because I think a lot of people are weighing in with their macro views when they don't really understand the banking system at all, right? Twitter's great for that. And so I would love for you to sort of give us the landscape. We have a Federal Reserve, that's our central bank. Then there are the member banks. You worked for the one in Dallas. I have one here in St. Louis where I live. Then there are the commercial banks. So can you kind of explain to people how the banking system in the United States works?
So actually, I wrote Fed and Bank Balance Sheet 101. That was my feather today. You have to think of banks as having somewhat unique balance sheets, right? We have assets, liabilities, equity. But what the central bank has is it has banks all across the country park money at the Fed, as if the Fed was this great big repository for reserves. So when we think of reserves that are parked at the Federal Reserve, they're collecting interest at the Fed. That's obviously very attractive to the banks. It's also politically a controversial subject, interest on excess reserves, as well it should be. And in that same sense, banks collect deposits from individuals, from corporations. And so you have to think of reserves as being kind of the central bank's answer to deposits from banks. On the other hand, there are liabilities. Liabilities at the Federal Reserve are in two different buckets. I think one of the hardest things for me to get my head around when I was first studying business, first studying economics, first studying accounting is that when you think of a loan, you always think of debt. Well, for a bank, a loan is an asset. So you have to classify that as being an asset for the bank. If you have the loan as an individual, that's definitely a liability on your balance sheet. But for a bank, it's an asset. So if you look at the Federal Reserve and its assets are predominantly during what was accumulated during quantitative easing, mortgage-backed securities and treasuries. So they've got $7 trillion of these on their balance sheet, but they also have assets just like any other bank would have in the form of loans. And so if if, for example, First Republic had about $11 billion in treasuries and in asset-backed securities. That's all they had in treasuries and asset-backed securities, which is why that bank in particular is somewhat hobbled. So they only had this small amount of money to take to the Fed's new facility where they can get par for those treasuries and mortgage-backed securities. Otherwise, they had this huge portfolio of municipal bonds. That's when you get back to the Fed's discount window. The discount window is where you as a bank, and you're hobbled and you're absolutely desperate for liquidity because you've had so many withdrawals, you don't have the money to satisfy customers lining up, as we saw 2 weekends ago, lining up around First Republics in San Francisco and Los Angeles. You got to have the cash. They had to go to the Fed. They had to take a loan out at the discount window at market value, which is a great big discount to whatever they bought that municipal bond for, plus a haircut, because at the discount window, you get penalized. So you're walking away with less money than you would otherwise have had. You're marking away with a lot less than what it is listed for on your book. And it's simply to live, to tell, to see another day. And I think I make that distinguishment because in Twitter, there are a lot of people who are saying, they're going to the discount window. They're going to this new facility because they're trying to get liquidity and they're going to pump liquidity out into the system and it's going to be inflationary. And I'm like, well, my best analogy has been that if you're in the ICU, you may or may not live, but they think that they could give you a blood transfusion. And so they give you a blood transfusion and you manage to survive the night and you wake up the next morning. What are you going to do? Are you going to go run the Boston Marathon? Or are you going to be grateful that you're alive, that you lived to see another day? You're going to be grateful that you're alive, but you sure as hell aren't going to say, take the blood out of my body and loan it out into the economy. That's going to be inflationary. You're not. In fact, the regulators are going to come down hard on you. The regulators right now are under the gun because the regulators have clearly been asleep at the switch in the United States of America. So if you are a bank that survives, the regulators are going to say, okay, we're going to have to rectify this problem. You've got interest rate risk that's boiled over. And by the way, you're not carrying loans where you should be. You need to shave off. I think the aggregate figure for the United States banking system, brand new figure that came out, is $2.2 trillion. That's how much money is being held on bank balance sheets as loans that are assets. That's how much they're carrying them above what their actual value is. So it kind of gives you an idea of the 101. But there's a lack of appreciation for how each of these buckets behave and how, if you get into a situation where you're even having a discussion about emergency funding, that means that you're also having it along a parallel line of a credit crunch, which is where we find ourselves today.
Wow, I really like your analogy of the blood transfusion. That's really interesting. And before I started studying our current financial system and banking, I would not have assumed that a loan, like if I take out $100,000, that's an asset actually for them. I would have thought that that's a liability, which is sort of a little bit backwards. And I think most people really don't understand. In fact, does every commercial bank right now, if you're a small regional bank somewhere, do you have an account with the Federal Reserve? Is that how it works?
Hopefully it is how it works. Yes. If you're a chartered bank, you do. You also have access to borrow through the Federal Home Loan Bank system. So borrowings in total in the week ended March the 15th increased by $475 billion. Huge amount of money. Now, only $164 billion of that was directly at the Federal Reserve. In that week ended March 17th, I want to say, the Federal Home Loan Bank system lent out $311 billion to banks all around the country. It's structured as a government. It's structured as a government-sponsored enterprise like Fannie Mae or Freddie Mac, which means it does not have the explicit backing of the US government, but it has the implicit backing a Fannie Mae or a Freddie Mac mortgage would have. The same, they're both called GSEs. The Federal Home Loan Bank is also structured as a GSE, and it has always been responsible, came about when farmers needed money for mortgages or individuals needed, but now it's a much bigger system, providing twice the amount of liquidity in 1 week to that which the Federal Reserve provided, but $475 billion in 1 week. That means that banks were on their knees.
Wow. Wow. Yeah. I mean, it's really interesting to think of this whole system as, you know, the different branches, the different smaller banks, they have this artery and these capillaries that all feed into the Federal Reserve. And you touched on in your article how we have seen sort of this consolidation over you know, the last decade. We had Powell in 2014, as you pointed out, saying that we need to fix this idea of too big to fail. But there seems to be less and less competition. And you have pointed out in your tweets before and in your writing that small banks, smaller regional banks, they're the backbone of America. And so if they disappear and there's less biodiversity in that industry, the working class, the middle class does not win out. Can you touch on that a little bit?
So there's a little bit of a story here. Every time that new regulations for the banking industry are written, they're fighting the last war. And sadly enough, that's what happened with Dodd-Frank. And when Dodd-Frank came to be a law, it put small banks under massive regulatory weight. They stress tested a bank that had $10 billion in assets, what we would consider to be a small community bank. Well, in order to offset the cost, because when you have to comply, there are people in every bank that are called compliance officers, and it's just pure overhead. They're not producing anything. They're not giving anything to your bottom line. It's just pure overhead. But these smaller banks had to comply with this new national law, Dodd-Frank. And it wasn't until it was much late, 2019. So for 8 years there, they had to comply with Dodd-Frank. They had to keep people on staff in order to be stress tested, like JP Morgan Chase or Bank of America or Wells Fargo, these systemically important banks that do need to be stress tested on an annual basis, stress tested at a higher, more rigorous level. And it is justifiable for them to have large compliance staffs, since their balance sheets are levered up and they're exposed to the derivatives industry. And yes, we need to keep a close watch on them. But during this period when small banks were being regulated to too great of an extent, in order to offset what they were spending to cover this new source of overhead, they went go-go. They went batty on commercial real estate loans that weren't in their wheelhouse. They were smaller banks lending to build skyscrapers in cities. That's not what a smaller community bank is there for at all. But they were trying to make up for, you know, kind of hotter loans, being more competitive than they otherwise would be, so that they could offset the cost of compliance. So you end up with, at the outset of the great financial crisis, small banks have 55% of all commercial real estate loans. They should have the majority, right? Because they are going to be in small town in America where maybe there's a new church being built, or, you know, a new small development if your suburb is growing. So they should have more in terms of commercial real estate than the big banks, but it should be just about balanced. Today they hold north of 70%.
Yeah.
And that's because, again, they were forced by regulations that were poorly constructed, poorly conceived, poorly executed, and not pulled back quickly enough to save the small banks. And in addition to that, they did what the biggest banks did. They followed the Federal Reserve when it was conducting quantitative easing into purchasing a mortgage at a 2.5% coupon, and now the coupon 6.5%. So they're also sitting on these unrealized losses on the security side of the balance sheet, just like the Fed, right? You've got securities and you've got loans. That's a bank's asset side of their balance sheet. Well, the securities that they own are upside down. Silicon Valley Bank, First Republic Bank, upside down on the securities holdings. And now we're finding out about Silicon Valley Bank. Lo and behold, when you get to those other assets on their balance sheet, which First Citizens bought as we're recording, today, First Citizens bought those for a 23% haircut off of the value of the loan book. Now let's step back and unpack that for a minute. So we know that office buildings are not as full as they once were. This is my home office. That's your home office. I'm not in an office building. So we know that offices are not as full as they once were. This is a structural impediment. So even if the Fed was to take interest rates back down to the zero bound, what would they accomplish? They're not going to fill the office back up. And that's why you saw Tiger Global take a 33% haircut on its holdings. That's the private market, private capital, private equity, private real estate. So that we kind of have our first price timestamp of about a third of a haircut off what's floating around there in the private market. And now that we have First Citizens having bought Silicon Valley, now we have a public bank haircut of about 23%. So there's your assets. You're impaired with interest rate risk and you're impaired with the value of the loans on your books. That's where we find ourselves today.
Well, so, I mean, let's play this out, because it seems like commercial real estate is sort of a ticking time bomb, is how I've heard it described. A lot of leases are coming up in 2023. You know, a lot of these banks have floating rates, or the companies took out, you know, loans when interest rates were very low. Those have changed. So how does this play out? Because that seems like if it trickles into the banking system even further, it could become systemic. I know you've mentioned before that what we've seen so far has not been systemic, but at the same time, the Fed has stepped in and opened up this discount window.
They have, and you don't, unless systemic risk is, well, let's be clear. Smaller banks have known that they've got a problem on their hands with these unrealized losses for some time. Because if you zero in on the discount window uptake, it started at the beginning of 2022. And so that's when we knew things were starting to be like, wait a minute, why is anybody at the discount window? Anybody. And then it exploded. Usually when you have an explosion at the discount window, and we had an explosion, if you add up the 164 billion between the 11 billion to the new facility and the 152 to the discount window, the weekend at March the 15th, if you inflation adjust the week that Lehman fell, that 164 is bigger than the 156 would be if you would adjust it for inflation. So we did have a more systemic event than the week that Lehman fell, purely looking through that narrow lens of the discount window. Forget the 311 billion from the federal home loan banking system. The Monday after Silicon Valley Bank fell, $111 billion from the federal home loan bank system alone. The highest one day in their 90-year history. Wow. 90 years. So we have seen a systemic event. And that's why you saw other regulators step in and say, whoa, nobody, I don't care what your currency is. I don't care where you are as a regulator. Nobody can set off a global systemic panic. You land in the Greater Depression. So it's just a no-no. So they had to put a floor underneath the panic. They had to put a floor underneath confidence. The question is, what's next? And because we're talking to each other from family offices, because it's a structural problem. In 2007, 2008, the Fed just had to open up the spigots. Okay, we have this new thing called zero interest rate policy. We have this other new thing called quantitative easing. So we're going to roll these puppies out. And so the problem in commercial real estate went away inside 12 months. It's not going away inside 12 months now. And that means that you can't even, it's not a liquidity problem at all. The liquidity problem with unrealized losses, if you're talking about a treasury and a mortgage-backed security that's going, it will mature, it will be money good, fine. But that's not the same situation with these loans. And so they're impaired. I think that it's quite possible that we're going to have to go through pain, because after the pandemic, we did see Jay Powell refuse to cross that last Rubicon. You can name them. There's little memes out there. You have people on CNBC losing their damn minds about they've got to come in and backstop commercial real estate. If they don't, the world's going to end. They've got to take interest rates back down to the zero bound. These are household names. These people losing their minds on TV. But Jay Powell refused to cross that Rubicon for commercial real estate. He refused that, God help me for using the term, bailout, when he was rolling out mainstream lending program, and he let the state of Illinois not blow up the municipal facility at the time. He bought like an eyedropper full of HYG. So he backstopped the high yield bond market. Not that he really had to spend much money doing it, or the investment grade corporate bond market. He did not go anywhere near the commercial real estate market. So, and that was we're not talking about 08, 09 here. We're talking about 2020, not too long ago. And that's because you're dealing with interest rates at a much higher level. Same situation plaguing any mortgage-backed security or treasury in terms of the interest rate hickey to the price of this bond, and then the structural impairment to the actual collateral. The bid and the ask spread are too wide.
Well, I wanted to ask you about that because I feel like this has raised some eyebrows. I mean, why do these banks get to post their underwater bonds as collateral at par? I mean, how is that even legal?
Well, it's legal because it's a treasury. So what the Fed is doing is taking something that has the full faith and backing of the United States government and giving par for it, knowing full well if said bank blows up, fails, goes away, they've pledged their collateral at the window. We can just hold on to it until it matures. Nobody loses a penny. That's the case. Nobody loses a penny. I mean, you don't exactly see Bank of America or JP Morgan Chase, or you don't see massive banks going, well, I've got a couple trillion of these things. I can get par for it. So I'm going to go give it to pledge it to the Fed. No, that's not how this is happening. Because if it was a free for all, then they'd take all their damn money and go to that facility. Right. It would have been maxed out at 2 trillion in week 2. Instead, it went from 11 billion to 56 billion. And we think that was probably because it was only open for 2 days. The facility itself was only open for 2 days, the week of the biggest take up at the discount window. Discount window went from 152 down to 110. And you have a little bit of a similar size shift over. That just means that banks who are getting penalized on their treasuries and mortgage-backed securities, they're like, I don't need to get penalized, but I got this. I took this to the discount window before this new thing was open. So I'll just move it from the discount window where I'm getting penalized and I'm getting market value over to the new facility. I'm still impaired. I'm still in the ICU. It's just, they're giving me better blood. It's good. It's awesome. But am I really going to go crazy and make loans right now? No.
Right. No. And I know that you've mentioned that that's why this is actually more deflationary. So I was hoping you could touch a little bit on that, because a lot of people on Twitter right now are sharing the Fed's balance sheet and how it's basically gone back up like 2/3 of what since quantitative tightening began.
Quantitative tightening. It's Armageddon. Oh my God. It's
yeah. It seems like there's been this debate that sparked of, is this QE? Is it not QE? Can shed light on that? Because I know you have been one of the people that's saying this is not QE and not inflationary.
All right. So Natalie, we're going to play a little Socrates here. So any bank in America 3 weeks ago, compare that to today. You walk in off the street and you want to take a loan out, and you're Joe Q banker, Jane Q banker at whatever bank in America you want to name it. 3 weeks ago, today, when would they have been more willing to give you access to credit for whatever it is you want to buy?
Way before.
Way before. Now they're a little freaked out. And their bosses have told them the regulators are coming. They're going to come and look at our loan book. And they're going to realize that some of the loans that we're sitting on aren't really worth where we have them on our books. So we're going to need a little bit more wiggle room here, loan officers. So when anybody comes in to access credit, if they're like Warren Buffett or God, you go ahead and extend as much as you want. Otherwise, come talk to me first, or make them pledge triple collateral, or whatever it is. This is what a credit crunch looks like. A credit crunch looks like, oh my God, we've just had a banking crisis. And oh my God, the regulators are finally going to come in and realize that, oh, you know what? The income tax refund season wasn't all what it was cut out to be. And we've seen this. It's just plain and true. IRS data. The average U.S. income tax refund is a negative 11% year over year. Now, why are we talking about cars? Auto dealerships call kind of the period between late February and early April, they call it Christmas, because that's when people go and they rush and they get their income tax refunds, and they kind of make it to where they're like current on their credit card from all that holiday spending. And then they go take it and plunk the rest down of the refund on a new car loan. That's not happening. And that's a problem, because people are like, wait a minute, where's my money? I was expecting to have more money. And I'm like, well, the federal government didn't give you as many things in 2022. So that you didn't have to pay taxes on as they did in 2021 and in 2020. So we apologize, but your income tax refund is smaller. There wasn't a child income tax in cash given to you that you didn't have to pay taxes on. There weren't supplementary unemployment benefits that you didn't have to pay cash on. So I'm sorry, but your income tax refund is 11% smaller than it was last year. So the liquidity that you thought you were coming into as a household ain't there. So you're like, well, shit, then I can't buy the car. So auto lending is clamping down big time. Auto lenders are stepping back entirely from the market, some. And that would have happened before even Silver Lake went, because nobody was going to have an effect on the size of your average income tax refund. That was just going to happen anyways. And lending standards were clamping down well before any of this happened as well across the board. So your starting point is the highest subprime auto delinquency rates in the history of mankind. That's your starting point. So banks were already saying, oh, okay, we've got some bad credit going on here, blah, blah, blah. And then a bank blows up. But credit crunches by definition are deflationary events. They just are.
It can get confusing because, if a loan is an asset, you would think that they want more assets on their balance sheet as opposed to, deposits that people want higher interest rates on. That's actually a liability for them. So this can get very confusing.
It can get very confusing. But if you know that the regulators kind of come in and say, okay, that's what you think your asset's worth. That you think your asset's worth 100 cents on the dollar. I'm here to tell you, you need to mark it down to 80 cents on the dollar or get rid of the loan altogether. So if you're a bank and you want to stay in business, you have to have that cushion in between what regulators are going to value that loan as opposed to where you have it on your books. So in order to make that wiggle room to where the regulator is not going to shut you down, you have to have a buffer. And that buffer is going to be in the form of only extending the most pristine new loans, especially because the new loans are being made at very high interest rates. So that means not only is it a really good credit-worthy borrower, but it's a great credit-worthy borrower who can afford these interest rates.
It's time for a quick break to hear these messages from my partners. First up, Bitcoin Conference 2023. This is the ultimate Bitcoin event every year, and it's going to be held once again in Miami Beach, May 18th through the 20th. Last year, there were about 30,000 attendees, and it's hard to believe the scale until you see it in person. There are incredible speaking sessions featuring the world's biggest Bitcoin voices, networking events, games, parties. I actually credit my career transition to the Bitcoin conference because I went for the first time in 2021, and that's where I dropped my first episodes of Coin Stories, not expecting this to become my full-time job at all, but just hoping to meet Bitcoiners and find more guests for the show. I actually went up to people like Michael Saylor backstage with a business card, and that's how I got him to come on the show. So anything can happen there, especially if you dream of working in the industry. Ticket prices go up every month until May, so don't miss out. And for 10% off, use the code HODL at b.tc/conference. I'll see you there. All right, next up, Fold. Fold is the best Bitcoin rewards debit card and shopping app in the world. You can earn Bitcoin on everything you purchase, from Amazon to groceries to sprucing up your wardrobe with Fold's Bitcoin Cashback debit card. And you can win free Satoshis every day, or even play for the chance to win a whole Bitcoin by spinning the daily wheel and the purchase rewards wheel. I have an alarm set every day so I don't miss out on spinning the wheel and earning free sats. And it's also a great app to get someone that is totally new to Bitcoin. So if you want to join the fun, head to foldapp.com/Natalie and get 10,000 in free sats when you sign up. Mm-hmm. I think it's confusing, the messages that we're getting from the leaders right now, because between Yellin and Powell, they're not always on the same page, right? And we heard from Powell, who spoke before Congress members and said the banking system is sound a day before the collapse of Silicon Valley Bank. And then you start to dig into the weeds, and the CEO, Becker, I believe that he was on the San Francisco board, right, of the Federal Reserve. Yeah. Is that a conflict of interest? I mean,
you cannot make this stuff up. You just cannot. I mean, you cannot make up what is going on with that particular situation. And he successfully lobbied Congress to make sure that his bank was not as scrutinized as it should have been given its gigantic size. It was the 16th largest bank in the country.
Right. They got to like 50 billion and didn't have a stress test, is my understanding.
Correct. It's all in too small to not fail. Word for word. I put everything in chronology. I can't say the word. But he successfully lobbied Congress. Had he not successfully lobbied Congress, he would have been being stress tested. They would have seen sooner than they did. Instead, you've got the San Francisco, the San Francisco Fed giving them great big check marks because they were a green compliant bank, as if the Federal Reserve needs to be involved in that, which they don't. But they were getting high marks because they were just as woke as the San Francisco Fed is. I didn't say that out loud. Apologies. I love San Francisco. It's a great city. Got married out there. But they were getting really high marks, but nobody was actually paying attention to their loan book on the regulatory side. So that's a problem.
But is it also a problem that Powell was out there saying the banking system is sound when he must have known that a lot of these regional banks did have underwater bonds. I mean, everyone at the Federal Reserve had to know that, right?
Well, of course, the New York Fed is reporting to Chair Powell, we've had more uptake at the discount window. Clearly, this is a building problem. But as somebody who used to work at the Dallas Fed, regulators exist in 12 pods all around the country. And it is the duty of the pods to regulate the banks inside of their districts. So should Mary Daly have been really raising the flag for Michael Barr, Vice Chair of Supervision and Regulation? And therefore, should Jay Powell have known it? Because his Vice Chair of Supervision and Regulation let him know, it rhymes with countrywide. It is the same exact district as subprime nuclear ground zero, and it's happening again on the West Coast. He should have known. But the duty started with the San Francisco Fed. Those are the regulators on the ground. When I was my last 4 years at the Fed, I was inside of banking supervision and regulation. I was inside of a little pod. I was hidden away from the PhDs in economics because I didn't play nice with them. Yay. But I was in Sup and Reg, and it is their duty to be on top of every single bank in their district and to report up to their president, and for their president to report up to the Vice Chair of Supervision and Regulation, and for Michael Barr in his position to have reported up to Powell. So it should have been known, especially because it was in the damn Wall Street Journal in November.
Right. Well, but why do you have Powell on one side saying, yes, essentially deposits will be protected, and then Yellin at the same time on TV or before Congress saying, no, they're only going to be protected at certain institutions or up to 200. I mean, what's with the discrepancy? And is there a point where Powell, although he would like to be Volcker, also doesn't want to be, Arthur Burns? At one point, he will have to do something he doesn't want to, just like he did during the pandemic. I'm sure he didn't want to do all that quantitative easing, but like you've pointed out in your article, he's had to basically back away, and the market led him in a different direction.
He did then. He has not backed away now, which is why everybody's in freak out mode. I mean, everybody. And the people I can no longer hear on my Twitter feed I call them the pivoteers. They're the pivoteers. He's going to pivot. He's going to pivot. I'm like, keep saying it. You've been saying it for 12 months now. You've been saying he's going to pivot. And for 12 months, the market's going to force him to. It's priced in. And I'm like, okay, there was no rate hike priced in when Silicon Valley fell. It was priced completely out. And then the market priced it all the way back up to 90%. He has a gift. If the market isn't where he wants the market to be with his thinking, he just talks and talks and talks. And he has Waller talk and he has Williams talk. Those are the only two you need to pay attention to, unless they're voters. Sorry, Bullard, but because Bullard's not voting. But he has his closest confidants talk until they talk the market back to where he wants it to be. And he's done it beautifully. Now, Yellin versus Powell. Okay, she's correct in what she said to Congress. Now, she's probably the Treasury Secretary who's had the least amount of interaction on the Hill. They say she hides. Powell, if you look at his day timer, which is required by law, he's got to spit that puppy out there. He's constantly up on the hill. Now, he's not like Machiavelli, Stephen Mnuchin, total shrewd Politico, blah, 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 but he's talking to them. And he knows that anything of this magnitude has to be done by Congress. You cannot say, I'm going to backstop all uninsured depositors when the power of the purse constitutionally lies with Congress. What Yellin was saying was, of course it's going to be money good, because of course Congress, who prefers to not do its job most of the time, 99% of the job, Congress prefers to say, God, let Powell take care of it, or let somebody else take it. I don't want to. No, that's not popular with my constituents. But when push comes to shove, if you want to backstop $9 trillion in uninsured deposits, that is not something that is under the purview of the Federal Reserve. It's not something that's under the purview of the White House. It cannot be executive ordered into existence, and it's not under the purview of the U.S. Treasury Department. It is only under the power of Congress to make such extraordinary moves. And Congress doesn't want to go there, but I can't believe I'm saying this, but Janet Yellen actually had a moment of being shrewd when she was on the Hill and she pushed back, saying, this is up to you, to the people questioning her.
Well, what's to stop Powell's hand from being forced again and maybe quantitative easing when, let's say, like the debt ceiling impasse passes and they have to issue more treasuries and our deficit just keeps skyrocketing? I mean, how do we balance that? How does he not pivot eventually?
Well, I think eventually is the key word, right? I mean, he was asked point blank when he was at the podium, are you considering lowering interest rates in 2023? I thought his answer was fairly brief and to the point. No.
Not base case.
He just said no. Yeah. And the reporter was like, but he said, no. So that's definitely not his base case. And again, he's going to have to talk the market into this unless something systemic happens. Unless Yellen has to go out and refill the nation's checking account. Okay. I have a checking account for my company. And I have a special checking account because I keep a minimum balance. So if I get a wire transfer in for making a speech in Geneva, I don't get charged that wire transfer fee. But that's only if I maintain a certain balance. My balance goes below that, I'm back in, I have to pay extra fees for this, that, and the other. Well, the nation also has to keep a minimum checking account balance by law, unless we're under emergency measures, in which case the Treasury Secretary standing at the time can dip into below that minimum balance all the way until it's depleted. It's about to get a nice injection, right? It's time to write those checks. We're finished with refunds. Once we finish with refunds, what's the next chapter? Writing Uncle Sam checks. So Janet Yellen's about to get a nice little reprieve because people all, by April the 15th, they all got to write their checks to Uncle Sam for their taxes. So she's going to get a little bit more cash in the checking account, buy a little bit of time. And then she's going to have to keep depleting it until there's no money. And then you've got these Freedom Caucus guys who don't appear to be bending at all, saying, we don't care what kind of smear campaigns you do. We don't care what you say to us. We don't care what advertisements you want to run on the television. We only care about policy. And we proved it because we forced 15 votes before we would let the speaker get his hand on that gavel. So, Sister Yellin, close the national parks, close the Smithsonian's, close it all down until you're ready to come and truly negotiate. That's who we're dealing with right now. So yes, this could definitely force Powell's hand. And remember, the day after it's resolved, that's when Janet Yellen's like, oh, sorry, early retirement, bye. Because who wants to sell $700, $800 trillion worth of Treasury bills?
Mm-hmm.
And all of a sudden people are like, oh, I thought quantitative tightening was sterilizing the effect of, I thought Janet Yellen running down the nation's checking account balance was sterilizing the deleterious effects of quantitative tightening on the broader financial liquidity. This is, oh God, it's not. She just sold $1 trillion in bills. Game over. But will it matter at that point? Are we going to have anything inflationary? Hell no. My God, if that's the problem. That's what people don't understand. Natalie, I know you're just letting me go on and on.
No, I love it. This is really, really helpful.
Another Socrates moment. So here comes a pandemic, right? Boom. whether it was made in a lab, whether it was running around in some squirrel. Here comes a global pandemic. So, guns loaded, here comes Jay Powell. Was Jay Powell alone in alleviating what ailed the country? No, he wasn't. The CARES Act was there. What was it? $7-8 trillion of fiscal spending.
Oh,
Plus.
yeah. I was actually going to pull up this statistic for you. PPP cost U.S. taxpayers $169,000 to $258,000 per preserved position, even though the median annual salary was $58,000.
Yeah, I saw that tweet. God love him. Waste of money, continued waste of money. Biden signed into law the biggest high net worth boondoggle of all time. The turn on any radio, whatever. They've even started advertising on TV. That's how, because they're running through the pool of the employee retention credit.
Yep.
Call getrefunds.com today. Well, that's nice because that's pumped almost $400 billion. I think once we get March or April, given the run rate of about 15 to 20 billion a month that it's pumping into the US economy, into the highest net worth people, mind you. So that's been about $300-400 billion since employers could first take that in July of 2020.
Right. Yeah, we're running long on that. I've seen Instagram influencers promoting that as well. And it's just going straight into people who are flying first class. And I know you've mentioned that on other shows.
Oh yeah, kids in first class. But that is actually being depleted. And my point to you is, I just walked through the resolute stance of the people who are going to hold out on the debt ceiling, these freedom caucusers. Good, better, in between, no politics involved, just human obstacles who have shown us how much of an obstacle they can be. My question is, if it took a double-barreled approach to create this inflation from hell, if it took $7 trillion of fiscal spending fully monetized by the Fed that extricates the banking system fully, banking system need not apply. The money was circumvented the banking system, went straight directly deposited into people. That's how you create inflation. You only create inflation not through loans, not through loans. You create inflation by giving people money, handing it out in cash. If we're still going to be talking about this debt ceiling in September, is there stimmy checks going into the mail if Fed pivots? Fed pivoting won't be enough on its own, people. It won't. It took the Fed and the federal government together to address the last crisis. But this GOP House ain't playing ball. They're not writing the stimulus checks, ain't doing it. And that's why everybody who's like, it's inflationary, I'm like, even if we get all the way to the zero bound and relaunching quantitative easing, what's he gonna buy? There's not extra money coming out of Washington anytime soon. This GOP House is not playing ball. And people don't want to sit and do the simple math. And that's the problem. They don't understand where the inflation's coming from. I was just looking through the entrails of the Dallas Fed's manufacturing service, largest exporting state in the nation, 11th largest country in the world, and delivery times for the month of March were 0.6. That's nothing. You needed a new scale. Delivery times were so messed up, but there's no more supply chain disruption. That's gone. If your delivery times are at the unch line, delivery times are no longer an impediment to doing business. In fact, by the way, China's on its knees. And it just cut steel production. So I'm not too damn worried about any kind of inflation coming from the supply side at this point. That problem's been completely resolved. You're not getting inflation from the GOP-led House of Representatives either. Maybe if it's closer to the election. But last check, we're in 2023, not in 2024. When after the debt ceiling's resolved, when they might be thinking of bending a little bit, if the recession's bad enough. But people refuse to do the post-pandemic math that shows you need not just ZIRP, zero interest rates, and quantitative easing. You need that plus the fiscal side. Add it together, inject it into the economy in cash, directly deposit it, then you create inflation. If you don't, shut up.
Right. I mean, I think a lot of people should have seen that this wasn't going to be transitory as well, because given that it's not just the monetary stimulus, but it is that fiscal side that it was fueling a bubble. I mean, home values skyrocketing, crypto bubble expanding, all of these things because the money had to flow somewhere.
Look,
But you know,
15% of auto loans are north of $1,000.
oh, I know.
Auto loan payments.
I know. I remember when those headlines were coming out that, you could sell your used car for more than what you bought it. I was like, that's
wait, what?
crazy. But I mean, you mentioned earlier that there won't be a pivot unless something systemic happens. But given how credit is contracting, how much pressure there is in the system, the commercial real estate concern.
That is tightening. That is Fed tightening, by the way.
So I guess, do you expect there to be something systemic given all the pressure in this? Because I know it's different from 2008 in the sense that back then, which a lot of people are making that comparison. They say it's 2008 all over again, but that was an issue of credit risk, whereas now we're more an issue of interest rate and duration risk, right? But
plus Siri's not a small $4.5 trillion industry is not small potatoes. And we know that the haircut's somewhere around 23%. So there is, I guess what I'm trying to say is it's different, but it's worse.
Okay. So
you got interest rate and credit risk.
So can you take me in two different directions? Because it seems like what you've been saying is Powell hasn't systemically broken anything yet. But at the same time, there's all this risk in the system. So how do we get that soft landing that I'm sure wants? And how do we potentially get a worse financial crisis than 2008? What are the two directions? It's time for a quick break to hear these messages from my partners. First up, CrowdHealth, a Bitcoin alternative to health insurance. Health insurance costs can be sky high today, and you essentially send money every month to a massive corporation, the health insurance black hole, as I call it. And if you don't need any healthcare, you never see that money again, right? But if you do need to go to a doctor, you end up having to pay even more out of pocket, especially if you end up as one of the 20% of claims on average that aren't covered. With CrowdHealth, you pay a small monthly fee that goes into an account that you actually accrue over time and is yours to use or keep if you ever leave. You can even save that money in Bitcoin. CrowdHealth is all about community, and the community crowdfunds everyone's healthcare. So if something does happen or you have a doctor visit, CrowdHealth will negotiate down the medical bill much lower than what insurance would be, and then the community helps you cover it. And in return, you help others cover their needs. For more information, you can head to joincrowdhealth.com/Natalie. And if you use promo code Natalie, you get 6 months for $99. All right, next up, iTrustCapital. iTrustCapital lets you invest in Bitcoin for your retirement with the tax benefits of an IRA. You can defer taxes on gains using a crypto IRA, or with a Roth IRA, you can withdraw tax-free at retirement. And here are some important things to know given the recent crypto contagion. iTrust does not lend against client assets. iTrust accounts are also FDIC insured up to $250,000 US, and iTrust does not hold customer assets or money. Assets are actually held between Coinbase custody and a custody platform called Fireblocks. And Fireblocks, by the way, underlies pretty much the entire industry. Their multi-party computation technology is the gold standard of custody for institutions and allows for private keys to be separated, encrypted, and shared across multiple parties in cold storage. So if you're doing retirement planning and considering adding Bitcoin to your IRA portfolio, you can sign up for an account and get a $100 bonus at itrust.capital/Natalie Brunell. How do we potentially get a worse financial crisis than 2008? What are the two directions?
Well, that brings us to Happy Tokyo. And if you imagine the disconnect on bank balance sheets in the United States between the market value of a treasury compared to what it would have been, I don't know, 500 basis points of tightening ago. Imagine what happens if Kuroda's successor flips a little itty bitty tightening switch at the Bank of Japan. So I think it's very dangerous to look at what we've just come through in isolation, because we did just have one of the 30 largest systemically important financial institutions on planet Earth go away a few weekends ago. And the the mismatch between the value of the market and the value of where Japanese banks had bought something would be way bigger than what's in the United States banks. So, and again, it's called the global financial crisis. It was global. So I think we have to keep the globality in mind when we're framing what faces us. But knowing that all of these instruments will be money good, the backstop that the Fed has set up with the Treasury is only $25 billion. That's the only loss that they have. So there's no loss involved, right? If they have to keep the collateral, then the Fed's going to mature out the paper and it'll be money good, fine. But what if they open the window to this new facility to other types of securities? That's what they're talking about today. It's all over my Twitter feed, which is, thank God I've been filming all day. I have to listen to it. But if they're forced to do that, then you start to say, well, is that $25 billion backstop enough? And you're talking about backstops. You're talking about that. When you say backstop by the Treasury, that is a taxpayer dollar.
That's a bailout, isn't it?
That $25 billion, again, we're talking about a $25 billion in the context of a $3 billion economy. So let's not get carried away here, kids. But even so, even if the Fed was going to try and provide relief for all the good paper that's out there, you still have this come to Jesus with commercial real estate. And I don't think that's anything that the Fed can do anything about other than to go back down to the zero bound, just to make refinancing somewhat less painful. But that's still not going to close the gap between the 80% occupancy compared to the 50% occupancy today for any given office building. It's still not going to make the fact that Foot Locker closed 400 stores just a few days ago. They're not closed, not onesies, twosies. We're going to be closing 400 stores now. So all of this is not going away. We forget that we were going into recession at the end of 2019. And then we gave U.S. households a ton of money. And so everything was okay for a little while. But we're just back to where we were.
Yeah.
And as far as what
people aren't saving, they're all living on credit cards right now. You've also pointed out the private equity and shadow banking sector and how they haven't had to mark their assets mark to market. That might be another bomb.
Well, that's what I was saying. That was a Tiger Global did. Tiger Global gave us the first stamp on that. So if we've seen on the public side with First Citizens taking a 23% haircut on the loan book, we've seen Tiger Global take a 33% hit on their venture capital holdings. So that's kind of our first clue as to how deep the losses are on that private side. And don't get me wrong, they're linked.
So eventually they will have to, what I'm getting from what you're saying is that eventually they will have to return to the zero bound, but that won't necessarily reignite the sort of inflation that we saw in the pandemic, because that was the result of both monetary and fiscal stimulus at an unprecedented rate because they needed to respond to the crisis and the economy shutdown. But what does that look like? When the pivot happens, what happens to Powell and his reputation? And what does that mean for the average American?
So here's where things get really dicey and people are like, so where would you like to live if it wasn't the United States? If things are bad enough, remember, we're talking about 4 holdouts here in one political party in one great big country who could make things really ugly. If the recession gets ugly enough and we're in 2024 and there is a lot of pain and misery, you could make the argument that you could end up with somebody really progressive.
Helicopter money.
Somebody's really progressive running the whole country. In which case my stock answer is, I think the people of Australia are lovely. And so, I mean, I had a speech there right before COVID, and I really, really find that the Aussies to just be fantastic people. So that's my vote, if we go that route. And just go MMT, UBI, and just go all the way. Let's just, I'll exhume all of our founding fathers with me. I'll charter a jet and I'll take them with me where we can still have liberty someplace else. Because once you cross that Rubicon of the only way out is illegally firing Powell, putting somebody in his place and again, that is the end of my opus. That is the grand finale of my opus. I've never been an end the Fedder, ever. Sorry, I'm going to go down an inch or two. Okay. This book, I use it now as a prop, but I mean, I wrote it. I don't exactly have to read it, but the last chapter of this book, it's not the new sheriff in town. It's not culture shock. It's chapter 24, but it has a title. The last chapter of my book goes through how to rebuild the Fed. It really does. Somebody asked me a really logical question a few days ago. They said, Danielle, what if we had a few bankers on the Federal Reserve Board? Maybe they'd have known, hey, they're piling into all this. There's interest rate shock building up. And I said, since you mention it, that's in the last chapter of Fed Up. I advocate for people being on the receiving end of monetary policy to be leaders at the Federal Reserve. I advocate for pension fund managers who have to deal with this crappy policy. I say that they need to be on the Federal Reserve Board. Anybody who's in receipt of, on the receiving end of monetary policy, they should be helping to make the policy. And that's not the way it is right now, when as it is full of academics. But if you tell me, Natalie, and people all over my Twitter feed, you're muted, I cannot hear your happy ass. But if you tell me the only way that monetary policy in this country can exist is at the zero bound, with the Federal Reserve monetizing every last penny of federal debt, there is no Fed. That's not you're not making monetary policy. You're setting interest rates at the zero bound, and you're monetizing every last penny of debt. We live in a hyperinflationary world. The Treasury Department can they can do a leverage, they can buy the Treasuries, they can buy the New York Fed's operations desk, and they can have the New York Fed operations desk buy all the Treasuries. I won't be in this country. I won't be living here, but nor will we need a central bank. You don't need a central bank to normalize interest rates or to keep interest rates at a level that allows savers. Hi, my mother is so excited. She's 76 years old. We're moving her into this 5% CD. She's so excited. She's like, you remember back in 1990s, I could get this kind of money on return on my money. You're going to teach your kids about compound interest, Danielle. I'm like, I know it, Mom. Isn't it awesome? So, if we can't have a 5% 18-month CD in this country without breaking the back of the economy, if we have to live at the zero bound, if we have to have quantitative easing going full blown all the time, there's no need for the Federal Reserve at all. You just absorb it into the Treasury Department, get that CBDC thing people are talking about. That way you can deliver it directly to the people, and you don't need the banking system either. You don't need anything. You also don't need Americans.
Well, I was going to actually ask you about the CBDC, because the last time we spoke, I think you mentioned that Powell is really against that, but it seems like the powers that be are blazing in that direction, with Fed Now launching in July. Do you have any updates on your take with regards to whether we're going to have a CBDC and what that looks like?
Okay. Powell says no. So firing him for cause means like the world ends. And the GOP-led House says no. So next. We're talking about Maxine Waters. Maxine Waters is like, we got to get the CBDC thing. And I'm like, Maxine, it's coming out of your mouth, Maxine, right? So, you're okay. And there's Bernie and Warren, and they're all together, AOC, just one big happy family. Again, a CBDC thing has to be legislated, and you have to get rid of Powell, which Trump tried to do and failed. So, you really got to be special to get rid of Powell.
One of the reasons why I love following you, Danielle, is because you really touch on all the nuance that's required to understand this very complex system with a ton of moving parts. The last thing that you talked about, it really makes me zoom out and think of where this is all going, because with the amount of debt that we've already accrued, I know that obviously Powell's goal is to keep interest rates higher and sustain them there. But even just keeping interest rates higher, even if it's at that 4 to 5% range, it is tighter over time, right? Because debt matures, and so it has consequences.
Your balance sheet runoff. And and people did not pay attention. I'm interrupting you, I'm sorry. But people did not pay attention to the fact that when the dot plot hit, the final Fed funds rate for 2024, December 2024, was risen from 4.1% to 4.3%. I'm like, people, hello? That means that they plan on staying higher for even longer than what we thought, and that we're only going to get 3 cuts sometime in 2024. That's like, Nobody can conceive of that not on Wall Street.
Right. Well, and going back to what you mentioned, you have to leave if we're just going to be at the zero bound and destroy and debase our dollar further. But I guess I don't see how we have an alternative way out of it, because we've exacerbated the problems and used the zero interest rate policy for so long that we've accrued all this debt. And there are so many malinvestments that now could potentially systemically affect the system. And other countries are starting to say, we don't want treasuries, right? They're starting to build parallel rails and payment systems, and they're de-dollarizing, which is also, I think, a threat to the US. I mean, if the Federal Reserve is the only one that's going to be buying our debt, then what's the point, like you mentioned? So do you see a future where you're hopeful that, do you want the US to be the global reserve currency and be the world's bank? Or do you see a multipolar world and have that be one in which Americans can still thrive and flourish and prosper? Like, what does the future look like to you?
Well, so I'm delighted that people call me a boomer. My mom is a boomer, but I am a little bit old-fashioned in my thinking in that the best thing that's on our side is that China does not want reserve currency status. But you typically, let me put it this way, since the fall of Rome, we haven't had what you're describing. We've only had reserve currency status change hands from one country to another, from one economic superpower to the next economic superpower. And don't get me wrong, there've got to be people in Beijing, as little money as they have right now, that are just, they're like this. You know, it looks like they're going to blow themselves up, and I'm so excited for it. And I hope to God that that's not the case. But there's actually an answer. And there is a reason that Jay Powell got interest rates as high as they are. And that's maybe because he knows that we can have a higher floor. Maybe we can stop at 2%, because 2%'s pretty low. 2%'s low enough to get a lot of credit going for good borrowers. For the bad borrowers, for the zombies in our midst, for the crappy companies, not even 2% will do the trick. Good, go, goodbye. Restructure. You know what? There's tons of kids coming up behind you who want to innovate and start new companies and take your place. So get out. You bad.
Does that mean 4% CPI instead of the 2% that we've been?
No, I did not say inflation. I did not say inflation. I said the overnight borrowing rate of 2%. Inflation needs to come back down.
But can it? Can we sustain 2% like you're saying, but then have inflation be the 2% that they are targeting? Or would that have to be higher structurally?
I think inflation is going to come down. If you look back at history, now onshoring could keep inflation higher, but you're not talking about 4% instead of 2%. But we're seeing, I just mentioned to you the Dallas Fed manufacturing survey. Delivery times are gone. That was one of the biggest sources of inflation was, you couldn't pay a truck enough to haul a load across the country when the worst of the supply chain disruption was going on. And now you've got one trucking company after another going bankrupt because there's way too much in the system now. We're oversupplied, we're overfreighted, we're overtrucked. So and we know that we're going to see, as a factor of demographics, we're also going to see natural declines in home prices as a factor of time, as the baby boomers either have their kids move in, or, which is happening a lot, or sell their homes, or sell their second homes. So, and these things are coming through with a lag, but there's what, a million apartment units coming online between now and the end of 2024. That's a mess. That's a lot of supply as well. And you've got a lot of homes being built as well. Those are your largest inputs to inflation, which is why I'm walking you through this. But as far as goods inflation is concerned, I go back to that GOP Congress not writing stimmy checks. So people are like, but gas will stay expensive. And I'm like, who's buying it? And that's what people don't understand. They want to talk about stagflation like the 1970s when there were these oil embargoes. We've become a massive exporting nation post Putin's first step across that border. And the Germans have innovated. And so they've got floating LNG terminals because it takes too long to build a physical one. So we've become a massive LNG exporting nation. So we're much more energy independent than we were before the war on the Ukraine, which is awesome. I mean, there's like a huge silver lining that, doom and gloom Danielle just pointed out. So we're not as dependent on other countries. We're not, if OPEC was to slap up an embargo today, who cares? But that's what created the stagflationary backdrop of the 1970s going into the early 1980s. We're not there. Unions aren't a huge power anymore in our workforce. So I can't name a source of inflation that's not going to be coming under undue pressure. When I went to go buy a dozen eggs a few days ago, it was half the price it was 3 months ago. So, and Americans know this. And that's why you're seeing inflation expectations in these surveys come down, because Americans see what they're paying for things.
It is really interesting because when you look at the landscape of analysts out on Twitter, you really do see two polar opposites. You see people who say that we will have potentially a negative inflation CPI print by the summer. And you have others saying that come fall, we'll have double-digit inflation. And so there's this great disparity. And obviously, one thing that I've learned just observing this space is we're often able to kick the can down the road a little bit further. Nothing is as extreme as maybe you read about it in a couple of characters on Twitter. But just as we start to wrap up, a lot of people are anticipating that we will have a harder landing, a recession that lasts, and they will need to respond to that, potentially even on the fiscal side if we have more unemployment, more people really, really struggling. So I guess, what are your sort of final thoughts and how people can best prepare financially, since a lot of my viewers, it's all over the place when it comes to what generation they're in. I have younger viewers, very hardcore Bitcoiners, millennials trying to have a seat at the table, as well as people who are older, retiring. So how should they play this whole thing?
So I think right now what's important is to always look at the source of the prediction and the forecast. I mean, I can sit there and look and say, oh, gee, the base effects after July suggest that any modicum of inflation growth is going to suggest that we're going to have a higher year-over-year rate. That's math. And I completely see where they're coming from. But, if somebody is out there and they appear to be a really big name, if it's somebody who is like, named Dr. Doom, for example, or somebody who's been saying we're going to have hyperinflation for the last 15 years, consider your sources really carefully, because the one you're talking to has no agenda at all. None, zero, zippo. So I think what people need to be applauding right now is the same thing that my 76-year-old mother is applauding. And that's that you can get a good return on your cash right now and be extremely safe and defensive. If you've got a job, if you're employed, this is the time to, when I was a kid, it was called hamburger helper. I don't know what it's called today, but this is the time to eat a few more meals at home, to up your savings rate a little bit more than you would otherwise, to turn your ears off when it comes to people who are like, as long as you're always in the stock market, you'll be fine. If it seems like the CAPE ratio is 29 on the S&P 500, it doesn't seem exactly value to you, then choose instead. Say, look, I've got this, I can leave it all hanging out there risk-wise, and then I can just work for an extra 20 years. No, or I can just go to the mattresses like a good Italian and collect that 5% coupon for the next 18 months and sit it out and wait and see how this is going to end up. All I know is that inflation is coming down, and that means I'm going to be making more on my money than inflation is, and I'm going to be safe. Keep your job. Work as hard as you can, save more than you want to in these coming years. Silver's cheap too, but be very thoughtful about what your personal finances. When I say personal finances, I mean what do you have in cash? Not in a bond, not in a security, not in a stock. What do you have in something that you can get liquid tomorrow? Because in times of high uncertainty, the more certain you are about where your liquidity is and making sure that it's earning something as a factor of time, you're sleeping at night. So even if you're 25, 28, 32, whatever, sleep better at night. Sleep is not overrated. But this is a time to be defensive. And if it involves spending more time with your family and going out to dinner less, so be it.
It's funny. You are kinder to Powell and everything that he's done than any other analyst I've seen. Is
That
it because you
doesn't mean
think
that I
he's
liked that transitory stuff pissed me off, and so did the whole bailout after the pandemic, and he bailed out his private equity cronies at the same time. I'm just cheering for the guy right now because the alternative is, okay, fine, maybe I don't want to move to Australia.
Mm-hmm. You're much more hopeful about us being able to land in a way that's not too devastating than a lot of the other people that I follow, including many in my space in Bitcoin, because it does seem sometimes that the future is a lot of doom and gloom in terms of our economy, that we've gotten to a place where the middle class has been exploited and hollowed out, and young people don't know where to put their money for it to be safe, and everyone's working multiple jobs. Now we're heading into a recession. It's like, what do you do when you look into the future but think, I don't know if I'm going to be able to be financially secure given what the policies have been. And so a lot of us, that's why we've found Bitcoin and think that we need a return to hard money. We need a return to something that's sound, that can't be inflated and manipulated. And so, but it sounds like you do believe that we can maneuver and thread our way out of this.
It's been a very, very long year for me. And the only thing that I can say is my oldest is almost 19 years old. I mean, I'm starting to think in terms of, God, he'll have a 20 handle a year from May. I mean, I want for this country to be a place where my grandchildren want to grow up. I do. I don't want for them to be born in Melbourne and say, hey, my grandparents emigrated here from the United States after socialism came into play in the United States and they introduced universal basic income. But my grandparents were from America. That's not the future that I want. So if Jay Powell can succeed in taking interest rates to 2% and have that be the new floor and have rational, actual decision making where you're not just like, I can do any investment I want because it's a zero interest rate environment. It's just blow as you go. I mean, that's not the real world. And so if he can create a place, if that's why he's here for the next 3.5 years of his life, because most people, they want to crucify somebody or they want to put somebody up on a pedestal. They don't want to put anybody in the middle. What about just somebody in the middle who's, yeah, he's wealthy. I get that. Then why the hell is he there? So he doesn't have to be there. I mean, what if he wants to make sure that his great-grandchildren have a country to be in and try and hold the line on the zero interest rate policy that in 2012 he castigated? And he hated QE then too. What if he just wants to shrink the Fed's balance sheet so it's no longer a tool in the toolbox because it's a really perverted, broken tool in the toolbox that needs to be thrown out of the toolbox? I mean, what if he's just trying to get sanity back? But in the process, don't get me wrong, he'd have to extricate Wall Street from the process. And it's the wealthiest people in the world, not the Bitcoiners, not the inflationistas. Nobody wants Jay Powell to fail. Nobody, as much as the wealthiest people on planet Earth. Because as long as he plays ball and gives them their zero interest rate policy, they can make sure that they can continue to widen the inequality divide and make sure that the middle class of America continues to get hollowed out because they don't have to play by the same rules as everybody else. So next time you ask, hey, I hope this guy burns in hell, ask about what else comes with that. Because last I checked, never met the guy, nothing against him personally, but Steven Schwartzman made $1.23 billion last year. That's a big paycheck. And it's a reflection of a warped world that I hope we escape. If you have not read Too Small to Not Fail, read it. Share it with somebody because it's a better ending. It's a better ending for the country than the utopia that's potentially envisioned that you only get to if you impose modern monetary policy and universal and you completely destroy the dollar. It's also a destroyed country.
Absolutely. Absolutely. I'm going to link the article. I think everybody should read it. And it's true. I mean, so many people have lost faith in the system. They see Wall Street getting bailed out and getting richer and richer and banks consolidating. And so they feel like, they are looking for some sort of life raft. And unfortunately, I think that environment is ripe for a leader to come in and claim that they will take away the pain by printing money or doing certain handouts, but it always removes your freedom. And we need a strong country with diversity among banks, among the working class, and currently we've been going in the opposite direction. So you've made me feel more hopeful that we can recover a little bit, Danielle. I really, really appreciate your time, and thank you for all your insights. Again, I'm going to link your newsletter, your company, as well as your most recent article, Too Small Not to Fail.
And it's free, so everybody read it and share it.
Thank you so much, Danielle.
Thank you for your time, Natalie.
Thank you so much for checking out this episode of Coin Stories. Again, hit like on the video and make sure that you have those notifications on so you don't miss out on any new episodes. And I would love to hear from you. If you have suggestions, feedback, guest requests, please email me at natalie@talkingbitcoin.com. Thanks so much.